Are you serious about planning a successful business exit? From Angel to Exit is your go-to resource. Subscribe to our newsletter at eckfeldt.com/podcast for even more valuable insights. And to get personalized guidance, take our free exit readiness assessment. It's just 24 questions, and it will give you a clear picture of your exit readiness. Find the assessment at eckfeldt.com/exit. Submit your results, and we'll schedule a free follow-up call to discuss your specific situation and the best way to maximize your valuation and ensure a successful transaction. Now, back to the episode. Welcome, everyone. This is From Angel to Exit. I'm Bruce Eckfeldt. I'm your host. Our guest today, Chris Maresca. He is a managing partner, interim executive at C32. Lots of experience with exits, working with companies, preparing for exits. I'm excited for this. I'm excited to kind of hear his experiences and what he's done and some of the things he's learned that hopefully we can benefit from a little bit. So with all that, Chris, welcome to the program.
Thank you very much for having me.
Yeah, it's a pleasure. Before we kind of get into our subject matter and start talking about kind of the learnings you have around the exit space, we'd love to get a little backstory, professionally, personally, like what early stages of this, how did you get into the business world? Give us a little bit of the story here.
Yeah, so I'm a serial startup entrepreneur. I've been in Silicon Valley for almost 30 years now. I've done 14 startups, had 7 exits, including 1 IPO. I'm a recovering VC. I actually started my first company in high school in the mid 80s and sort of went from there. And I've done a lot of different things, but finally landed in tech in the middle of the first .com boom, and wound up working in a bunch of crazy things, and I've seen the entire evolution through, the rise of the internet to mobile adoption and all the craziness around that, and now the craziness around AI.
Another wave.
Yeah, and I think along the way, I've done stuff like I built the first Starbucks website. Everybody's always amazed about that, which was an e-commerce site. Before that, they were the website for Lilith Fair. If you went to Starbucks.com, it was Lilith Fair.
Interesting.
Yeah, at least because they sponsored it, and they didn't actually have a website until I built the first one, and then built a bunch of brands like that, and then did a bunch of things in logistics, in health tech, in other things like environmental startups and other places like that. I also ran a music startup for a while that was pretty successful. And I owned a consulting firm for a while that did startup turnarounds. So VCs would hire us to turn around their startups. And we did about 50 of those. And some of them were really successful. Probably the most prominent one was Jaspersoft. It was sold to TIPCO for, I think, $200 million. We also did turnarounds for really big divisions of companies. So we re-platformed Nokia's firewall division, and that sold to Checkpoint for $1 billion. So all kinds of different experiences. Right now, I work with private equity on doing technical due diligence on acquisitions. So I do pre-deal technical due diligence. But I'm also helping out companies that are looking to be acquired to help them figure out what they need to do to prep for that. It's interesting because I did a lot of early stage startups, and now I'm totally at the other end of it. I'm doing exits. And so it's kind of an interesting, I still work with early stage startups. But I'm easily bored, so I like doing lots of things at once.
I know that feeling.
Yeah. And
I'm curious, did you always, like when you were young, you knew you were going to be an entrepreneur, you were going to start businesses, or like when did that first kind of idea for you that I was going to be in a business and start a business happen?
That's an interesting question. And, a few years ago I turned 50 and I wondered myself what the hell I was doing, putting myself through all this pain and difficulty doing startups. Right. And I realized when I was in university, actually in my late teens and into university, I did a lot of extreme sports. I jumped out of planes. I did extreme skiing. I actually was an extreme skiing instructor for a while. I was a wilderness EMT. I did ice climbing, all kinds. I did blue water racing, all kinds of stuff like that. I even tried out for a Formula One feeder team at one point. So all kinds of extreme sports. And I think to me, startups are sort of my adult version of extreme sports, right?
Exactly.
I can't do extreme sports because I physically, over probably the age of 30, it's kind of impossible. I mean, you can do it, but it's just not the same thing. You don't have the physical stamina to really keep that up.
Yeah.
But startups are kind of my equivalent of that. And I always tell people, startups are a terrible way to make a living. Because you for every good idea, you have half a dozen that suck. And you waste a ton of money trying to make those things happen. Even if you're just subsidizing your own lifestyle, never mind investing in some new business. So it's been an interesting ride. I've done okay for myself, and I've landed in a pretty good place. And private equity is interesting. I'm working on multi-$100 million exits, which is kind of interesting. So.
Cool. Yeah, lots of questions on those, but I want to. I would love to kind of hear about kind of the first time you found yourself in a business where a potential exit was possible or at least contemplated. Like, when did that happen? Like, what transpired to get you to the point of like, hey, I actually have something I might be able to exit from?
Yeah. So interestingly enough, that didn't occur as a founder, but as an employee. So I moved out to Silicon Valley in 1998. I moved to San Francisco, and I joined a company called Organic. Organic invented the banner ad, and they owned 60% of the advertising inventory on the internet when I was working there. And they were a powerhouse because they were created because they invented the banner ad, but nobody had websites to point the banner ads to. And so they wound up building all these websites, which is how I wound up building Starbucks.com and AutoZone.com and Mercedes-Benz.com, HomeDepot.com, like all these big brands that wanted to advertise on the internet, but they didn't have any place to go. So I was employee 180. It doesn't sound like much, but when I left 18 months later, there were 4,000 employees.
Yeah.
And so it was a crazy, spectacular, even by today's standards, was insane growth. I mean, we were we had 7 offices when I left in like 3 countries. It was ridiculous. Yeah. And they were prepping to IPO. And that was a crazy ride. And I did not understand the first thing about, the mechanics of this. Like many people come in from elsewhere, you just don't understand how this works. When I got there, I pushed for a higher salary rather than taking more stock options, which was probably a mistake, but I really didn't understand how any of this worked. And that was pretty interesting. And I left before they actually IPO'd, which actually was fortuitous because I escaped the lockup that exists around IPOs. So that was kind of an interesting fortuitous thing. And then I joined some friends with a logistics company where we did introspection on the customs clearance process. So you could a complicated niche. But we sold that company to Excel Logistics eventually. And that was another exit. And then I joined a music company called Music Fans. We were really successful. We had the top 300 fan sites on the internet, music fan sites on the internet. So in aggregate, we were like the 3rd highest destination, which was crazy.
That's interesting. Yeah.
And that was really, really pretty crazy. And the problem is that Google didn't exist. So monetizing that was relatively difficult, like Google Ads, so you had to sell ads directly.
One by one.
Yeah. Which was kind of really difficult. But that eventually exited as well. Not as much as we had hoped. And then, I went through a series of other startups that good and bad. I mean, exits, how much money do you make? It's all kind of highly variable.
Exactly.
It's a funny story. In my consulting firm, we always took equity from startups in exchange for a slightly lower rate. What people didn't understand is we actually pushed up our rate artificially.
Yeah, of course.
And then reduced it and got equity.
It was the bonus.
So we had one company that exited and we were like, oh, cool, because we own quite a bit of shares. We were on the phone with the CFO and he was like trying to figure out how much money it was. And he's like, yeah, you guys get $280. So, you're like, okay, well, it was an exit, but I mean, geez, You know?
At least you didn't owe money.
Yeah, right. I mean, maybe you pay taxes with that, right? But
Yeah,
some
exactly.
portion.
Well, by the time we figure out transaction costs,
Yeah,
you actually owe
exactly.
us.
You're left with 12 cents, right? You know?
Yeah.
And so, yeah. So I think, and this is the reality of startups, right? You people. I mean,
Yeah.
I just had this discussion with the founder because she's trying to build a company that, her goal is $30 million exit, and I'm like,
Mm-hmm.
okay, by the time you get diluted to hell over the next 5 to 10 years, you're
Mm-hmm.
probably going to wind up with less money than if you just organically, bootstrapped it and kept a hold of the whole thing and maybe grown
Mm-hmm.
to, 5 million, but then at exit, you'll probably have more money in your pocket.
Yeah.
Um,
Or, I mean, I find some of these companies, it's just like cash flow it, right? Like run it for another 10 years and take the cash. I mean, if it's a profitable company,
oh
but
yeah,
it's not super sellable,
yep. And she's
right? Like
already
it's,
profitable.
yeah,
And so, and I'm like, if you return $500,000 or $1 million a year,
yeah,
then why? But she wants to learn how to scale the company, which I
yeah,
understand.
yeah.
And her goal is to make enough money to start another company that she has an idea for. And
Mm-hmm.
so, okay, I get it. But even then, maybe taking investors and going down that route, maybe the dilution will be more than you want.
Yeah. Yeah. Because once you do, I mean, I always say, like, once you take on an investor, like, then you're on a treadmill, right?
Yep.
Like you've got to exit. You got to return that capital somehow, some way, sometime. So
Yep. And people
yeah,
don't make that calculation because it's also dependent on these, where the fund is in its life cycle when they
yeah,
invest in you. Funds have 10-year life cycles typically. And the
mm-hmm.
first 5 years, they're investing in net new. And the next 5 years, they're investing in their winners and scrubbing everything else. And if you're
Mm-hmm.
if you're in year 1, then you might have a 10-year runway.
Mm-hmm.
But if you're in year 4, then you probably have a 1-year runway to show that you're viable,
Mm-hmm.
which is a
Before they
different
start
dynamic.
calling.
And then at that point, the pressure's on, right?
Yeah.
And so people don't really get that. I always tell people research the stage the fund is in,
Mm-hmm. Yeah. That people don't understand. And the other problem or the other dynamic, I tell them, like, for a founder exiting, right, this is a once in a lifetime, maybe you'll do this 2 or 3 times in your life. Like for the other side, this is Tuesday,
Yeah.
right? Like they just do this again and again and again, right? So the asymmetry in these deals is significant, and being prepared for that and understanding that and knowing how the other side is really treating this and what this means to them is a really different beast. Let's go back. I'd be curious, like, what was the first, I guess, company where from day one the intention was to exit, and you had a very clear plan, kind of time frame. Like, what did it mean? What does it mean to start a company with an intention of exiting or with an expectation of exiting?
Yeah, what's funny is I don't work like that.
Okay.
And I think there's a material difference. It's somewhat changed in the recent times. People are pursuing money more than they ever used to. But at least in Silicon Valley, people started companies because of idealism or because they're scratching an itch or solving a problem or something like that. And the major goal was to do that. The exit was a sort of secondary issue, if you will.
Okay.
And for me, that's always been, I'm always, somebody, I think there was a comedian I was watching the other day. He said, always lead with curiosity, which I thought was an interesting way of putting it. And I feel like that's been part of what I do. I'm very interested in all kinds of things that have nothing to do with tech. And I like that. I want to know more about the world that I live in every single dimension. And those things often lead to startup ideas, which have nothing to do with my personal, history of work, but are just novel ideas that I think are interesting. And those things materialize into businesses. And then sometimes they're viable and they exit because somebody likes that idea. Sometimes they're just totally not. And I think that sense of exploration is what drives a lot of entrepreneurs. It's not about looking at the exit. Now, the flip side of that is as soon as you take investors, you must think of the exit. I have a 3-slide deck that I used to give at startup conferences, which was, what you need to know. And, focus, remember the customer, and remember that you have to exit. you know, and the rest is just like whatever, right? I mean,
Yeah.
and I think, you know, once you have investors, there is an impetus to exit. But until that point in time, really what you're doing is trying to figure out how to make something that, you know, the reason why you're charging money for it is because you need to make a living, not because you necessarily want to charge money for it, because you're just trying to solve a problem, really.
Yeah.
And so
Yeah.
I think, and that's a good entrepreneur, right? If you're
Okay.
aiming for the money in the first place, you're probably likely to fail because you're not passionate about whatever you're doing. I think, right? You know, but Silicon Valley is a very particular place, right? It is structured for that pipeline of naive startup entrepreneur, you know, and we're going to squeeze you until you're worth something, and then we're going to sell you off. Right. And I think, and that's very Silicon Valley. And most people don't really, people come in at the front end of that. They don't understand that meat grinder that they're getting themselves into. And there's a reason why VCs will say, oh, I'll never invest in somebody over 40. And because,
why?
Because people over 40 know better. and so, you know, and they know better than to put themselves through that kind of stuff. And so that there is that. The other thing too, I think that's important, and what distinguishes Silicon Valley in particular from the rest of the world in terms of investments is that the VCs in Silicon Valley want to go for the brass ring. They're not going for the incremental difference. They're going for the thing that's going to blow it out of the water, which means that you have an inordinate amount of failures. I mean, you know, people who enter into, you know, who seriously start a company have something like in a 1 in 1,000 chance of making it the other end. Never mind people who actually get venture. We all know the stats around that. But even if you're just starting a company and you're hoping to make it through that process, it's like a 1 in 1,000 maybe if you're in Silicon Valley. So, yeah, I mean, I think for me, the driver has been curiosity more than money making. I'd be a whole hell of a lot richer if I focused on the money aspect, I think. But I don't really care. I have enough money to live. It's not, you know, whatever. It doesn't matter. And and I think you'll find that for people who are truly successful, the money's just a metric like everything else. It doesn't really.
Yeah. Well, at some point, it's a scoreboard number.
Yeah.
It starts measuring success or you know.
Yeah, but most people
setting
just
goals
ignore it anyway, you know?
Yeah.
I think, and like I said, I think it's only in maybe the past 10 years that Silicon Valley has become so money focused. I'll tell you how I notice it most, which is going to be a crazy kind of metric, is you never ever, I'm sure you've been to LA. When you go to LA, there's a lot of very flashy stuff going around, right? And in Silicon Valley, that was never ever the case. Right, you would never see a supercar ever. Like people drove Toyota Camrys or whatever, or maybe a Tesla in recent years. But I have seen more and more kind of ostentatious car purchases to the point where McLaren has a dealership in Palo Alto now, you know, which tells you a lot about what's going on. And I think there's that pursuit of money. I mean, in previous days, you would have taken that, whatever, $250,000 from McLaren and you would have given it to a startup. You know, that was where you're spending your money. And I think that mentality has changed. And I sort of worry in a way that undermines what made that area great. And I don't know whether that's true or not, but I suspect it might. I mean, certainly San Francisco is not what it used to be. And that's a shame because the creativity that you need doesn't exist. Organic, which I was just talking about, which invented the banner ad, was started by a DJ. Do you think that would happen now? Probably not. No, never. And that's a problem because it's too bad. The outliers of society are the people with the most novel ideas because they're not part of the mainstream. And if you exclude those people from your ecosystem for whatever reason, then you are missing a whole wealth and richness of ideas that don't percolate to the top anymore. So anyway,
So in terms of prepping for an exit, like in the situations where, okay, you've got a company, we have some kind of time frame for an exit. What are the things that start to come into play when an exit is kind of on the horizon? Like what shifts in terms of what you're focused on or what you do or kind of how you operate? Like what kicks in at that point for you?
Right. So I'll speak with private exits. IPOs are totally different ballgame.
Yeah.
And but at least in terms of private exits, whether it's a strategic or it's private equity, we have huge due diligence team. I mean, I'm working on a company right now that has $10 million in ARR, and I got there's teams that focus on specific areas of the company. So there's a financial due diligence team. Obviously, there's a legal due diligence team. There's a commercial due diligence team that looks at, the market and the TAM and all that kind of stuff. There's a technical due diligence team, which I typically lead. And then depending, there'll be other due diligence, regulatory, compliance, whatever. On this $10 million deal, I got a deck from the commercial due diligence team, and it was 200 pages. And it was 200 pages of crammed with data, right? And this is what you're on the other side is doing, right? Yeah. And, on that $10 million deal, there were probably at least 40 people on the due diligence team.
Oh my Lord.
Right. And that's a small deal. That's a tiny deal.
Yeah.
Right? On a bigger deal, you might have 300 people. Right. And of course, with AI and automation, all that, those numbers are going to go down invariably. Yeah. But whatever. The point is, these people are doing all kinds of research. We have a group in the private equity firm whose only job is to find people to interview, either ex-employees or people in that vertical that know everything about what's going on in that vertical. I mean, these are like CEOs and C-level officers and VPs and stuff. And we get those people. We get incredible people to talk to. So I spent a lot of time interviewing these people, trying to find out what's going on, either within the company or the industry or whatever. And they're invaluable. But can you imagine the amount of work that it takes to do that? And so you're on the other side. You're this $10 million ARR company that is trying to sell itself. And in the case of this company, they don't have a professional working with them, and it shows. Because when you ask them for documents, that in a deal, a virtual data room will be set up, and there'll be a list of documents that are requested. And they need to be accurate and complete, and you need to be able to deliver them quickly. So when I ask you for, the easy one to look at is, P&Ls and stuff like that. They need to be completely accurate. More than that, you need to understand all the metrics that are the drivers in your industry, and you need to be able to pull those off at the drop of a hat. I was just talking about this entrepreneur who's trying to grow her business to $28 million. I said, what's your EBITDA? And she couldn't answer that question. And why couldn't she answer that question? Well, because her accounting system is not set up to deliver that kind of data. Yeah. And so it starts there. You have to start with, what are your fundamental systems? Accounting, HR, give me a list of the people in your company and their roles and functionality. You got to be able to produce that on demand.
Show me their employment agreements. They're not compete.
Yeah, exactly. And people are going to go through that in scrutiny, but there's other things too. Your sales and marketing needs to be spot on, because people like me, I work in technical due diligence, but I will look at all that stuff and say, how does this relate to what you're delivering? And how can I see the synchronicity in that? I was looking at another deal where the company has its own data centers, which is weird. Probably stupid, but never mind.
We won't judge.
and I was like, why on earth? And then somebody said to me, somebody on another due diligence team said, the CEO thinks he can do it better.
The data center? Like, that's why they have it? Oh, okay.
Well, better than Amazon and Google and Microsoft. Fair enough, right? And then there was another, and just to give you an idea, like, about how you need to have all your ducks in a row, I heard an anecdote from somebody we were interviewing, one of their clients, who said they promised to deliver us this feature and they completely failed to do so. Right. And my view was there's a certain level of arrogance in this company that is showing up at the CEO level, and also this sort of poor sales guy who over promised and under delivered. And you look at that and you're like, this is not aligned, right?
Yeah.
Somehow or another, and you read the Glassdoor reports of the company and people are like, the management is chaotic and so on and so forth.
Yeah.
And you go, okay, all these things add up to a picture of the company. So when you're looking at exiting, you need to make sure that all of this stuff, HR, accounting, sales, marketing, technical infrastructure is all scrubbed and perfectly justified, right? And also that you, as an executive team, when people ask you questions, you can answer them immediately. Like you have those numbers in your head, you have that information in your head. If I say to you, what happened with this client, you'd better know the answer to that because I already talked to the client.
Yeah, exactly.
Right.
Yeah.
And if you don't, then that's an issue. Can you imagine? I mean, it's worse when you're exiting, because VCs will do this too when they're looking at investing at your company.
Yeah.
And if you're missing some idea of the market that they know, then that's a red flag. But it's even worse at exit, because at this point, you've figured all this out, right? When you're making hundreds of millions of dollars a year, you better have all this stuff figured out.
Yeah.
And I was looking at one investment, and halfway through our due diligence, they replaced their CFO, which told me that perhaps their accounting system wasn't up to snuff for what they were doing. So all of this stuff, you absolutely have to have everything in a row. So you have to have all the corporate systems all working and aligned properly.
Yeah.
You need to have, I look at stuff like, where's your documentation? How do you onboard new employees? What does your hiring pipeline look like? I'm also looking out for corporate culture. I'm looking for, are you requiring people to work a ridiculous, 996 schedule?
Yeah. Are you burning people out?
You're burning people out. What's your turnover look like? What does your compensation look like? We have this notion in private equity about remediation costs.
Okay. Tell me more.
So when we look at all this stuff, we assume if there's red flags, we assume we have to fix them in order to bring a higher valuation at the next sale, right? Because it's all about flipping the company over a period of 5 to 10 years.
Yeah.
If you have a high burnout rate and we have to increase the team size to reduce the workload on people, there's a cost to doing that. We'll calculate that as a remediation cost. If you have a data center and we have to move it to cloud, we have to calculate the cost of doing that as remediation costs. And guess what? That all gets put up against your valuation. Yeah. Right? Because now we know we're going to buy you for, $300 million, and now we're going to have to spend $50 million fixing all your broken crap. And so, and we look at that, and that's my job is pre-deal, is to try and calculate what's wrong with the tech infrastructure that we're going to have to fix, and how much is that going to cost us? Are you kind of towing close to the line on licensing costs and some things? And when somebody does an audit, you're going to be in deep trouble. Is that going to increase your operational costs by $20 million a year? I don't know. This is an important thing to know. And so I think when people are looking at exit, you need to have all that stuff aligned. It's helpful to bring in professionals before you go to an exit. Because when you don't understand how to deal with the professionals on the other side, these giant teams of due diligence people, and B, you don't know how to get all your systems in line for that. Yeah. So
I think there's a concept here that I talk about, which is, I think you're highlighting, which is, you can actually be a super valuable company, have great numbers, have great technology, great customers. But if you don't have the ability to demonstrate that and show that and communicate that well in a sales situation, it doesn't matter. Like the company, if they can't see it and they can't do the analysis, they can't do the diligence, they're not going to make an offer, or they're still going to have to apply, a big discount or a big delta on that to be able to get it. So, yes, you need to get those systems in place. You need to collect those documents. You need to make sure everything's running well, but you also need to document it in a way that can communicate well and easily. So I talk about being buyable, right? Like you can have a great company, but if you're not buyable, if you haven't set yourself up to be buyable, like you're going to have a difficult time. At best, it's going to make it long and complicated, and you're going to spend a lot more time and a lot more drama on the transaction process. Absolute worst is they don't do the deal, or they just apply a big discount to it, and so you're not getting your full valuation. What do you think of? I do this with a couple of companies where we do mock due diligence, right? Where we come in and we pretend like we're going to go through it, and it just starts exposing all the issues. What would be your recommendation for how companies kind of test themselves on how ready they are to go through a diligence process?
Well, yeah, I mean, that's something I've been helping companies with on the technical side. I think it's a really good idea. I think, you should also do other things. If you're big enough, say more than $50 million in ARR, then you should have an audit, an accounting audit of your systems. But accounting audits also turn up other problems often, not just accounting. So that's like a first basic step. But you should also have, you need a legal audit. Like somebody needs to go through all of your contractual documents to make sure they're solid. Are they solid? Yeah. Because you know what? The PE or the strategic due diligence team will do that. Oh, yeah. And they will ding you if you don't have that. I think, technology is a little more difficult because it's often baling wire and duct tape, let's face it, everywhere. Even if you're, a Fortune 100, it's still baling wire and duct tape. Yeah. And so there's a certain amount of tolerable baling wire and duct tape, but there's also certain things you're doing that are exposing you to unnecessary risks, sometimes existential risks, cyber attacks or whatever. And you need to do that. So, you can start by doing stuff like, having a cyber audit and having, penetration testing from the outside to try and figure out where the weaknesses are in your systems, but also do an audit of all your licensing and everything like that. Like that's the name of the game, is try to figure out where all the buried things that you would need to deal with are, and then bring them to the surface and either note that you know about them, and that, that there's a strategy, at least on an outline to do something about it. Yeah. It's not so much that all your, you have something that's wonky or glued together with a glue gun. It's not that, it's do you know about it? And you have a strategy to deal with it. Have you noted it and said, we need to do something about this eventually? Or do you not know about it and it's just underwater? Like that's the worst part. And somebody's just going to discover it. Now there's some cases where I worked years ago, I worked on a fitness group in Southern California that was doing $30 million in ARR and was doing accounting off of Excel spreadsheets. Okay. I mean, obviously, that's a valuable business, but there is a remediation cost, and it's okay. Like, given enough, clever financial due diligence people, they can extract the numbers out of that stuff. But there's remediation costs to that, and you either have to eat it before you go through that process, or you have to just note it and just say, well, you're going to pay for it one way or the other. Either you pay to do it before the sale, or you're going to pay for it on the valuation. I have another one. I was going to say that this practice that I use in a lot of companies that are thinking about due diligence is I have them put together what I call the skeleton list. It's like, what are all the skeletons in this company right now? That's a good way of putting it.
And I tell them, put that on the table day one, right? After you have the initial kind of, you go to dinner, hey, they might be interested in, slide that across the table and say, look, these are all the skeletons and here's the plan around it. Or, we're going to do something about these. These were not, right? Like just know it is up front, because buyers know they're there. Yeah. And if you can be up front and you slide it and they say, great, right? And nothing else comes up, it's going to make the whole process easier. You're going to build trust. I mean, particularly if you're staying on. I mean, that's the other one, is if you're selling and walking away, that's one thing. But if you're selling and you're staying on private equity and you're going to be running this company afterwards, I mean, talk about building a relationship with the buyers, right? Like you've got to have that if you're going to have a successful earnout and do a second transaction.
And the other thing I will say is, if we discover a skeleton, then it brings everything else into question.
No, exactly. Yeah.
And so that actually, the example I gave about, the CEO being confident he could do data centers better than whatever. And then the sales problem that cropped up, then I went back to their sort of pitch deck that they had for PE. And there was a couple of slides in there specifically about, employees and corporate culture and all that stuff. And I looked at that and at first I had thought, oh, this is great. They really care about this stuff. And then it became, no, maybe this is actually a red flag, right? Because I discovered this other thing. And then we had a discussion internally about that. And like, what does that mean? And now people are going through everything looking for red flags, right? And so this is the other thing too, is that once you find one, you figure, okay, in consulting, we had a thing, we said the fish rots from the head, right? So if the leadership team has a certain style, then that permeates throughout the company. And now we're looking for other places where that has caused issues, in whatever way. Right. On the other hand, another company I looked at, they had just spent $2 million on a marketing company that had redone all their materials and redone their demos. And their stuff was absolutely terrific, right? I mean, they had other issues, but that's money well spent because that matters a lot in the initial stages of people looking at stuff. I mean, it matters in general for your for your growth, but when you're looking at stuff, we have a tendency to act like customers initially and try and figure out and push and pull in that sense. And then we're interviewing all of your potential customers and all of your existing customers, or at least as many as we can dig up. And so that stuff really matters because you will get a lot of positive feedback from that. So I think people are a little cheap on spending money on external services that will improve intangibles. And I think that's a mistake because the intangibles at the end of the day are really important. Sometimes they're the most important thing. I was joked that like tech is the easy bit because by and large computers do what you tell them to do. And you might tell them the wrong thing and then they do something stupid. But sales and marketing is driven by a bunch of people. And on the other end, you're talking to a bunch of people and people are randomizing. And so you need to spend more money on that, ironically, than on the tech. And a lot of companies are not, especially engineer-led companies, are not willing to do that. And they don't respect that profession and that part of the business as much as they do the technology, which is an issue. So you mentioned earlier,
that private equity particularly, has teams of people doing diligence and things like that. And also that you mentioned this, where they are in a fund, right, can really change the dynamics. And I think most, I would guess all but a few sellers, and maybe if you've gone through it before, you don't think about these things, but like, where is the buyer? Where are they in their process, in the fund process, in the fund life cycle? What are they going to look at? What are some things that you think sellers really need to understand about buyers and kind of what they're looking for and what their frame is when they're evaluating a business? Because sellers are always, they think about it in a very particular way, right? It's their baby, right? Like that's not how buyers think. What are a couple of things that would help sellers better understand the buyer's position and what they're really looking for?
So at least at the PE firm I'm working with, the process starts with identifying targets. They have a fund thesis, that defines, what they're looking for. And then they identify a bunch of fund targets. And then they will do initial phases of due diligence. There's a phase one, which is at best you're talking to the executive team to see if they might be interested in selling. And so on. There's like an outreach, and then part of our due diligence team will talk about that. And then we get a bunch of initial documents that are we describe as pulse documents. And so there'll be a technical pulse, a financial pulse, and various things. And then we'll go into a phase two. And this process, well, I'll talk about timelines in a little bit, but the phase two is a little more detailed. Then that's where I come in, me and others. And then we start to do what we describe as outside in. So we don't talk necessarily to the executive team or the company. We may not have a virtual data room yet either. We're just trying to do research about the market space and what people think of the market and everything. And that's where we get like the commercial due diligence documents and those things from outside in. And then all of that, and this is the important bit, all of that stuff goes to an investment committee. And that's pretty typical of most PE funds, where those people take all that data and they decide where they're going to put their money. Right. So up until this point, there's no we don't know the valuation. We don't know whether we're actually going to pursue it. We don't know anything, right? We're just trying to figure out what's the baseline for this thing. And then it goes to an investment committee, and the investment committee's got some voodoo magic that they do that I don't know. And then
crystals and witchcraft.
And then they come back and they say, well, this is what we're going to do. Now, that's where I am right now. So the investment committee started mid-September. I don't know exactly when we're going to hear back. I hope sometime this month. And then the cycle starts over again in January, where they're going to start looking for acquisition targets again. And then we're going to move into phase 3, into the actual, trying to negotiate a deal and look and do like a deep probe of what's going on in this company. And that's kind of the way it goes. Normally that process will take, at minimum 3 months, but can take up to a year. However, what's been happening recently is that there are deals that are closing in like 3 weeks, which is ridiculous.
Okay.
Which is ridiculous.
Why and why?
I don't know. This is happening in venture as well. Venture is even shorter timelines. I've seen venture deals close in 5 days.
Wow.
And it's insane. There's no time to do due diligence. I was asked to look at, this company with millions of dollars of ARR, and somebody to ask me to judge their infrastructure in 2 days because they were going so quickly on a deal. And I'm like, I'll guess. I'll give you a swag, but I can't do anything cogent. There's no way in 2 days. There's no way. And so for whatever reason, in the last 6 months, the process has accelerated, and I'm not entirely sure. I think people see an inflection point. The dollar's particularly low right now. The private equity fund I work with is an international private equity fund. So for them, their money is in other currencies. And so they're buying
it's a steal.
Cheap American companies. They're also trying to get ahead of, I think, and I'm not entirely sure about how this works, but I believe they're trying to get ahead of the drop in interest rates.
Yeah.
So I think that the combination of the two is like forcing a sort of a feeding frenzy, right?
Frothy environment.
And I've heard there's about $7 trillion sitting on the sidelines of untapped money that's in money market funds right now. And so people are also wary of the influx of that money.
It's going to drive up prices.
Right, exactly. And the fund I work with has about $80 billion in assets under management. So they're one of the larger funds. So they have the cash and the cash flow to jump on stuff early. So I don't know.
Is this going to change the way we do diligence? I mean, I can't help but think at some point someone comes up with just different ways of trying to get this work done, right? That, accelerates the process if people really want to do these transactions in weeks rather than months.
Yeah, we do a lot of what we describe as desktop research. And our technical due diligence teams, I can't speak to the other ones. We use a lot of AI to drive that. And we've built sort of agentic AI workflows to deliver a lot of initial results. We always have to vet that data because we don't really trust it. And on the technical due diligence teams, we have specialists in different areas. So we have a very well-known AI researcher who's on our team, which helps a lot with figuring out that kind of stuff. And so you can only do some of this work accelerate that by doing that. We've also been expanding the technical due diligence team. It's a tough call because technically in finance for this kind of stuff, we're not supposed to use any AI. But I'm an outside contractor. I don't actually work formally for the firm. So I'm not subject to the regulatory controls that they're under. So we can get away with it to a certain extent. But you have to be careful. That stuff. I mean, I've had AI rewrite my resume and it makes stuff up, which is hilarious. I mean,
Yeah.
I love it. It makes me look better than I am, but I'm like, okay, that's not, it's not correct. And so you do have to be careful. But yeah, I think
Yeah.
right now what people are saying is in PE, the front end of finding targets is going to be largely AI driven.
Yeah.
And then I think a large chunks of due diligence are going to be also AI.
Yeah.
The problem is, you can't, there's a big people component in this, and people do really stupid things, and AI doesn't understand the stupidity.
Yep.
And so you can't, there's only so much you can do there.
Yeah.
You
Yeah, I
know,
get it.
and talking to other humans is probably the best way to figure out what's actually going on.
Yeah. Yeah.
But I have no doubt there's going to be a lot of disruption. There's so much money though. I mean, it's insane. There's, I don't know whether you've heard the stat, but right now we're going through the largest intergenerational
Yeah.
transfer of wealth in the history of the world.
Yeah. The silver tsunami.
It's $17 trillion.
Yeah.
It's insane. And so there's two things there. One, all of those companies that the boomers created are all being bought. There is the opportunity to buy them up because the kids often don't want to take over the businesses. The second thing is the kids are inheriting all of this cash, right? So millennials and Gen Zers are inheriting a lot of the cash. And already we're seeing that in housing markets, places like LA, where you get these millennials that, work at Starbucks and are putting $600,000 down on a house. And they're getting that money from their parents, right? So, and I think it's pretty interesting because there's a lot of dislocation happening at various different levels. We all talk about AI, but it's not just that. It's this whole thing. You get a whole generation of businesses that are disappearing effectively. And all that money has to go somewhere. And what's going to happen with that? I don't know. It's hard to predict.
It is hard.
Yeah. So I think it's pretty interesting. And PE is a pretty boring place in general because it's all a bunch of investment bankers. And they're very conservative. I joke to people, I said, if you want to get in touch with PE people, don't email them, just call them, because they don't want to reply to emails, because emails are, they're part of the audited stream of data. So,
yeah, exactly.
Yeah,
they official document.
Yeah, exactly. Part of the compliance regime. So
Chris, it's been a pleasure. If people want to find out more about you, the work that you're doing, what's the best way to get that?
They can email me at ckm@c32.co, or visit my website, c32.co. And that's 32 like the number 32.
Perfect. I'll make sure the links are in the show notes.
Great.
Chris, thank you so much for taking the time today. It's been a pleasure.
Thank you. It's been great. Thanks so much.